After closing over $50 million in real estate deals, I've discovered that 90% of investors are choosing the wrong strategy. Today, I'm ranking every major real estate investment strategy from best to worst, and the top spot might surprise you. In this video, I'm breaking down 10 different real estate investment strategies and ranking them based on real-world results. You'll learn which strategies actually create generational wealth, the hidden financing tricks that separate S-tier from D-tier investments, and exactly how to choose the right path for your first deal. But first, let me show you why most investors get trapped in low-tier strategies that keep them from reaching their full potential. Want to know what separates the top 1% of real estate investors from everyone else? It's not their market timing or their connections, it's their strategy selection. Last month, I watched 2 investors start their real estate journey. One chose our S-tier strategy and just closed on their first duplex with 30-year fixed financing at 20% down. The other went the sexier route, trying to flip houses with hard money at 12% interest, and is still struggling to find their first deal. Here's the fascinating part. They both started with the same amount of money. Most people don't realize that strategy selection isn't about what makes the most money on paper. It's about what creates sustainable wealth with the least risk. The reality is, the boring strategies often build the biggest fortunes. Here's something shocking about real estate investing that most gurus won't tell you. The best strategies are actually the simplest. Our S-tier consists of just 2 approaches: traditional buy and hold and the BRRRR method. Buy and hold investing is like having a money printing machine that gets more efficient over time. You buy properties with long-term fixed-rate mortgages, let tenants pay them off, and watch your equity grow. The BRRRR method takes this a step further. You buy distressed properties, renovate them, rent them out, refinance to get your money back, and repeat. Both strategies give you multiple profit centers: cash flow, appreciation, tax benefits, and debt paydown. What most people miss is that these strategies work because they're repeatable and scalable. While everyone else is chasing the next hot trend, S-tier investors are quietly building empires one property at a time. The key difference? These strategies work in any market condition because they're based on fundamental economics, not market timing. Here's what they're missing. These A-tier strategies require more active management and come with higher risks. Let's take short-term rentals. Yes, you can make 2 to 3 times the cash flow of traditional rentals, but you're essentially running a hotel business. I've seen investors make 6 figures from a single Airbnb, but I've also seen them lose everything when local regulations changed overnight. Multifamily and wholesaling fall into this tier too. Great potential returns, but they require more expertise and capital to execute properly. The fascinating part about A-tier strategies is that they work best when combined with S-tier foundations. The most successful investors I know use short-term rentals to supercharge their cash flow while building their long-term buy and hold portfolio. Now let's talk about flipping houses, our B-tier strategy. House flipping is like running a small construction company combined with a real estate investment firm. It can be incredibly profitable, but it's also incredibly risky. Most people don't realize you're not just investing, you're taking on a full-time job. Let me share a real flip that illustrates why this is a B-tier. We bought a house for $300,000, budgeted $100,000 for renovations, and expected to sell for $500,000. Sounds great on paper, a $100,000 profit, but then we discovered foundation issues that weren't visible during inspection. Add $30,000 to the budget. Then the market shifted slightly during our renovation, and similar homes were now selling for $475,000. Suddenly, our $100,000 profit turned into $45,000. The hidden complexity of B-tier strategies is that they require perfect timing and execution. Even experienced flippers typically only complete 3 to 4 deals per year because each project demands so much attention. Compare this to our S-tier investor who can manage 10 rental properties in their sleep. And you start to see why these strategies rank where they do. Let's dive into our C-tier strategies: syndication, private lending, and subject to deals. These aren't bad strategies. They're just highly specialized and often require either significant capital or extensive expertise to execute properly. Take syndication, for example. I recently had an investor friend pitch me on a $50,000 minimum investment in a multifamily syndication deal. The projected returns looked amazing, 8% preferred return plus profit sharing. But here's what most people miss. You're completely dependent on the operator's ability to execute. When I dug deeper, I discovered the operator had only managed properties half the size of this new acquisition. Private lending and subject to deals share similar challenges. You're either trusting someone else with your money or trying to navigate complex legal arrangements. Last month, I met a private lender who learned the hard way that those high returns come with hidden risks. Their borrower's flip project went sideways, and now they're stuck either foreclosing on the property or extending the loan at a loss. Now we've reached our D-tier strategies, raw land and commercial real estate. Let me be clear. There are people making fortunes in both these areas, but they're playing a completely different game with different rules and massive capital requirements. Commercial real estate perfectly illustrates why certain strategies land in D-tier. Last year, I analyzed a strip mall deal that looked promising until we discovered the true complexity. Not only did it require 35% down on a $5 million purchase, but the loan had a balloon payment after 5 years. In today's market, with online shopping and remote work changing consumer behavior, these properties face unprecedented challenges. Raw land might seem simpler, buy low, sell high, right? But here's the reality check. I know an investor who bought 5 acres outside a growing city for $100,000, expecting development to reach his parcel within 5 years. 8 years later, he's still paying property taxes with zero income, and development went in a different direction. Remember how we started by asking about the best real estate strategy? The truth is, the best strategy isn't about maximizing single deal profits. It's about building sustainable wealth over time. That's why buy and hold and BRRRR sit at our S tier. They're not just investment strategies, they're wealth building systems that get stronger with time. The most successful investors I know started with S-tier strategies and only ventured into other tiers once they had a solid foundation. They understood that real estate wealth isn't built on home runs. It's built on consistent base hits that compound over time. After analyzing thousands of deals and working with hundreds of investors, I've learned that the best strategy isn't the most exciting one. It's the one that builds lasting wealth while letting you sleep at night. Whether you're starting with $50,000 or $5 million, success in real estate comes down to choosing the right strategy for your goals and situation. Hit subscribe because next week, I'm breaking down exactly how to get started with S-tier strategies using less money than you might think. See you in the next video.